Okay, gang. Well, good evening. Good evening. Glad everybody could make it on time and get in here. It's great to go ahead and see each and every one of you. John is here, and John, you're welcome to jump on in there and just make sure your microphone is sounding great as well. And hopefully everybody can see a screen that says Small Lot Trading Strategies and hear my voice okay. And then we'll see if John wants to jump in there real quick and say hello as well.
I'm here, Rob. Thank you very much. Hopefully everyone can hear my voice. How does that sound to everybody?
Yeah, you sound absolutely great, John. Absolutely great. And super. Well, so we're going to go ahead and kick it off here. It's going to be a little bit different this evening in a couple ways. First of all, I just want to say hello. I'm just looking down the list here, all the people that said hello. A nice cast of characters, a lot of our regular student family here, and it's great. I invited our newsletter student family to make sure they could keep learning as much as possible. I know John's got a great group of people here as well. So hello to each and every one of you there. Paulie, we intend to, but the thing is, you don't want to count on recordings. We've had more than our fair share of recordings that have bombed out, and we always encourage people to go ahead and stay through the whole thing, just because sometimes they bomb out. We actually had one a few weeks ago that the internet went out in the middle of the thing, and that kind of messed everything up and bombed out. So you just never know. So it's always better. So with that being said, what we're going to do is I'm going to kick it off with a couple of housekeeping items. Now that John had a chance to say a nice little hello there as well. So again, we're going to be doing things a little differently tonight. I'm not going to really talk a lot about myself. I'm not going to really talk a lot about John. Hopefully you guys already know who we are. It's a fantastic opportunity, whether you want to learn from myself as an international trading champion or you want to go ahead and learn from John, an incredibly seasoned veteran, author of several books, and all-around great guy, and just a world of experience in these markets as well. So there's a lot of opportunity here for you this evening to continue to grow as traders. So they'll be done a little bit different there. This night we're going to get right into the meat. After we just talk about a couple of disclaimers there, this training session for your purposes and your purposes only, gang. Please don't go ahead and try to bundle it up and sell it somewhere else. We've had, both John and I have had that happen actually, so we have to ask you guys refrain from that. This is for your use only. Also, trading does go ahead and involve risk, not just reward. I've seen it all over the internet here. More and more of these trader educator types are going ahead and putting up these big wins that they're going in and having, and they're not telling you about the big losses. The reality is, trading does involve loss. Most of you here know that. If you're small lot traders, which is what the purpose of this event is tonight, you probably more so than a lot of people are going ahead and quite familiar with loss, because you're going to have to keep, you're either keeping them with really tight stops, or because of the psychology that a lot of small lot traders go through, you're suffering unnecessary losses. And so you know all too well that trading does involve loss, not just these big fancy profits that a lot of people are putting out there. So we want to go ahead and remind you, always check with your registered financial representative and your risk trading plan before investing or trading in anything here, okay? Also, since we might talk about options as well, just a reminder, always take a look at the options, risk disclosure statements there. Here's a great website. You can go take a look at that. Since both John and I are very much into options as well, you may hear us talk about various options-related strategies using some of our small lot trading techniques here, okay? So does that make sense to everybody? Everybody understand that? And if so, then what we're going to do is just go ahead. I've got lots of different strategies, several of these are very appropriate, in my opinion, for small lot trading as well. And so what we're going to do is we're going to talk tonight about the speed line continuation trade here. I want to talk about that, and then John's got some really cool stuff that he's going to share. I've already seen his slides, and I'm really excited for him to go ahead and be last, but certainly not least, as he has some additional great stuff to put together as we throw all these things together, things that you should know. Okay, so with that said, what is the speed line continuation trade? Well, basically it's a trend continuation trade off of our fast or slow speed lines. Now we're going to go ahead and talk about those in a few minutes. And if you don't have what I refer to as my speed lines here, that's great, gang, no worries. Anybody who's a member of anything at my website has access to that. The newsletter members, which we recently did a great offer for, the live trading room, whoever you may be. But if you don't have that, just go ahead and use like a 4 and a 6 period exponential moving average, for instance. It's certainly not going to be perfect, but at least gets you a proximity or a vicinity, to have something to use. Okay, if you want all the exact settings for the starter package of indicators, you said you just be even a newsletter member to our website, and we get you that. But so as we're talking about the speed lines there, we're using these basically in trends. Okay, the speed line continuation trade. So where's the entry? It's usually pullbacks to the fast or slow speed lines here. And by the way, gang, I would recommend that you don't go ahead. Can you turn the music down? Gang, there shouldn't be any music. If anybody's hearing any music, let me know. You guys shouldn't be hearing any sort of music other than myself there. And I see Danielle's out there, Danielle B. Warm good evening to you too. And for all of you here, I see we have, what I would say is, don't go ahead, no music, good. I was going to say there shouldn't be any music, so might want to check that ringing in your ears. But I would strongly urge you not to leave and go ahead and come back here. We're getting to the point now where it looks like we're getting close to the webinar locking up, so they only allow you like a 30% overflow on the number for 1,000 people, and so just keep that in mind. So with that said, where's the entry on this? Basically, it's at the fast or the slow speed lines based on your risk, and I'm going to talk to you about that in just a few minutes. Where's the exit? Well, you guys know I'm a big proponent of going in trailing trades, trailing for profits, and otherwise you can also use the next key support or resistance level. Okay, so, and Judy, that's what we're talking about right now. So SLC stands for Speed Line Continuation Trades. All right, so I'll probably hold off on some questions there till a little bit later, just to keep the flow of this, because for most of you, I think this will make sense if we just go ahead and give it a little bit of time. Where's the stop? So basically, it's a slow bleed through the 20-period exponential moving average or beyond the slow speed line based on risk. Now, some of these trades are based on the fast speed line, some are based on the slow speed line, but both of them can use the slow speed line as your stop out point. Okay, a more aggressive variation of that would be letting it pull all the way back down to the 20-period exponential moving average. Now, yeah, fine, good evening to each and every one of you as well. Thanks so much, gang. People are still coming in and saying hello. So as we go ahead and we talk about key points, remember, for a small lot trader, it's very important to understand that the distance from the speed lines to the 20-period exponential moving average is very important. Okay, speed lines to the 20-period exponential moving average is very important. So let's go ahead and take a look now as we look at these in kind of the various examples. All right, now we're going to look at different types of instruments, some different time frames here, particularly the 5-minute, 15-minute, 60-minute charts. Since most of you as small lot traders are trading on an intraday basis here, taking advantage, I assume, of the intraday margins that your brokers afford you to go ahead and take advantage of leverage for your smaller size account. Is that a fair assessment for those of you that are smaller lot traders? You're going ahead and trading 1 to 3 lots, 1 to 5 lots, focusing on going in capital growth, account growth, and then utilizing, yeah, that's what I thought. Okay, the screen's flying by there. So with that said, keeping that in mind, we're going to focus on some of these intraday timeframes here. Now, you can easily substitute this concept, though, for a day and a weekly chart if you're talking about your favorite options trades. Okay. Oh, wow. Okay, great, Ross. And by the way, welcome as always. Good to see you as always. Ross has been trading 1 lot for 2 years now. Okay, so, and again, I want to go ahead and emphasize, as we talk about 1 lot and 2 lot, okay, Rhonda, that's the best you can do. I know you've been asking for a long time. That's the best you can do to kind of approximate these. Okay, so Ross talks about being a small lot trader for using a one lot for 2 years now. One thing I would say to you guys as a reminder, and just a little, hopefully a useful tip, and hopefully this will help you from a motivation perspective. Gang, what I find out for myself is, like, when I go off the reservation, when I go ahead and find myself, because I'm a very large lot trader. Any of you that don't know, I'll easily trade hundreds of contracts, okay? And so it's not uncommon for me. I'm at a different level of the gang. I've been doing this for many years, and I've had many successes. I've also had many failures along that way, getting to where I'm at in the trading business and earning my place in history. And so for me, it's a different game. But I tell you, when I start finding myself kind of going off the reservation too far, what I find, one of the things that helps me the most is getting back to some of these small lot trading techniques and just trading more size. Did everybody hear that? Did that make sense? So that sometimes taking the more conservative small lot trades with your big account is often a way to get back on track when you find yourself going ahead and, yeah, exactly, because the small lot trades are meant to be higher probability by nature. Why do we need to be higher probability by nature as a small lot trader? Exactly, Wayne Z. Back to the basics. You got that right. Why? Because every tick counts in your small lot trading account, doesn't it? Is that a fair assessment for all of you? Win, lose, or draw? Every tick counts, doesn't it? Every tick of profit is necessary. Every tick of loss kind of stings, doesn't it? Exactly. So bottom line is, that's why I want to go ahead and we want to focus on these. And if you can, even as a large lot trader, if you're starting to go ahead and kind of unhinge off the wheels, that's one of the things that you can go ahead and focus on, is doing just that, is kind of getting back to some of these basics. So as we talk about this now, let's look at some examples of what this looks like. And I want to get my drawing tool up here for you. So give me just a second to turn this on. Okay, so what we're looking at now from a perspective, and there's a lot of different tools on here. These are basically the same chart, just different time frames. The only difference is right here, these are like pivots, okay? That's the only real difference. But otherwise, they're basically the same chart, just different time frames. So as we look here at the Russell, in this particular case, what we're looking for is these speed lines here. And we talked to you, like I said, a poor man's formula, if you will, poor trader's formula, is like a 4 and a 6 period exponential moving average, if you want to use something like that just to kind of approximate these. What happens is we go ahead and are looking for pullbacks to these in a trend. Okay, well, what are different ways we can identify a trend? Well, obviously, I've got some great tools and indicators. John's got some great tools and indicators, but you can also use things such as a 20-period exponential moving average to help you identify, the trending. So what I'm typically looking for is that 20-period exponential moving average, ideally being around a 45-degree angle up or 45-degree angle down. So if I were to clear the screen of all different charts and indicators and things like that, I would go ahead and still be looking at that 20-period exponential moving average to at least give me some advantage to the market in absence of, a major advantage, okay? So first thing we want to do is identify a trend. Then from there, what we're looking at is looking for pullbacks. Now, does everybody remember a little bit ago I said we could either use pullbacks to a 3-period exponential moving average, or a 4-period exponential moving average, right? Or you can go ahead and use like the speed lines, right? So we can go ahead and have a pullback to the speed lines, the fast one, or this one over here, which you can use like a 5 or a 6-period exponential moving average if you don't have the speed lines. And so what's happening here is it's basically a pullback. Now, what's the difference here as a small lot trader? Well, let's just take a look at this for a moment. A pullback to the fast speed line here. All right. Well, the distance between that fast speed line and that slow speed line on an hourly chart here can easily be, well, especially during the regular trading session in like something like gold or crude oil, could easily be 30, 40 plus ticks away from each other. So the difference is the amount of heat that you're willing to take between the prior to getting stopped out on the trade. Does that make sense? So in other words, the closer that we have the entry to your stop out, but that you're closer to resistance, the better. So this is why, as a small lot trader, the what a lot of traders will do, the more I don't want to say aggressive, but the more excited small lot traders will go ahead and take this trade near this fast speed line. The more slower, the ones waiting for a little bit more of a pullback, will go ahead and wait to take it closer to the slow speed line. The reason being is because then you're taking less heat. The distance between the fast speed line and the slow speed line could be several ticks, as we just talked about. So going in and waiting until we get closer to this point takes away some of the heat, takes off some of the edge for a stop out. Now, what's the risk? What's the risk there of waiting for it to pull back to the slow speed line, gang? Exactly. Exactly. Very good. Jesse, Nora, Larry, Edward, Wayne, Robert S., Frank, Mike Z., Tom S., Bruce P., okay, the screens just keep on flying by here. So you guys all got it. Exactly. That's right, Scott, Mike, and everybody. So the bottom line is you may not get a fill. Okay. Now, what this boils down to is a couple of things. Like if you're like most traders, you'd rather be on the sidelines wishing you were in a trade than in a trade wishing you were out, correct? So for some of you, let's just do a quick little survey. How many of you here start to get a little bit nervous about a trade if it goes 5 ticks or more against you? 5 ticks or more against you. You start to get a little nervous about your trade. Wow. Okay, look at that screen flying by there, John. Okay. Now, how about if it goes more than 10 ticks against you? Okay, some people say they're out after 10 ticks. Okay, great. Stop by then. Okay, all right. Wow, thank you very much for the information. So the bottom line is every tick really does count there, doesn't it, for some of you? Okay, and Vasilis says, I get nervous there, and lots of little comments from different people, so wonderful. All right. So clearly, what we're talking about here is that every tick counts. That just kind of reinforces and proves my point. And I appreciate all the participation there. Got a great group. So with that being said, then what we're talking about is pullbacks to the fast speed line, okay, will get you in earlier. And in the strongest trends, the good news slash bad news is it may go ahead and only pull back to those before it takes off again. Do you understand? In a trend, in some trends, you'll have the opportunity to get the pullback to the slow speed line, and then it will take off. But in many trends, it may only pull back to the fast and then launch off again, especially in the strongest of trends. Early on, a junior trend or that's just starting to go ahead and take off may go ahead and just go pull back just to the fast speed line. Okay. Now, why is this important? This is important. This whole strategy that we're talking about here is meant to capture trades early on in a new trend, and yet have tighter stops. Does that sound like something that a small lot trader is interested in? Exactly, absolutely, gang. So with that being said, that's why I'm focusing on this particular one. I've got many different setups. I've got many different setups within the whole speed line continuation realm. So this is just one category of them that we're showing here in brief tonight before we go ahead and get to John's. So what we're looking at here, you'll see these are just multiple examples. This is the Russell. Here's the S&P. Okay. And so what we're looking at is we're looking for pullbacks to the fast or the slow speed line, and then looking for reentries. Now again, what's the difference between a fast speed line entry and a slow speed line entry? The level of aggressiveness. If you get in at the fast speed line, you may have to sit through it pulling back to the slow speed line. And as many of you just said, within 5 ticks, you're starting to get nervous. Within 10 ticks, many of you are out. Now just think about that for a minute. If the difference between a fast speed line and a slow speed line can go ahead and be 10 ticks, depending on the time frame you're looking at, that can make all the difference in the survivability of that trade. Okay. Now, well, and that's a great point. Rosemary says, I like the entries closer to the 20 on this chart. Well, Rosemary, that's great. By the way, welcome as always, Rosemary. It's great to see some of you ladies, Rhonda and Rosemary and others that join us at all these events. Well, let's go back and see what we said here. For the small lot trader, the distance from the speed lines to the 20-period exponential moving average is critical. Remember that? We just said that, Rosemary. So I agree. Why is that? Because if you think about this, gang, would you rather go ahead and take a trade earlier in a fresh trend when you're first going in pushing up, getting your pullbacks? Or would you rather go ahead and take your trade later where now you're so far away from the 20-period exponential moving average? Look how much heat there could be in this trade. In this particular case, from this point to this point is over 50 ticks. Okay. All right. So as we go ahead and let's look at some more examples here then. All right. So this is the 30-year bond. So we're going ahead. We're looking for a trend. We've seen the downtrend in the hourly chart. We see pullbacks. Now you see here, this first one pulled back to the fast speed line. The second one actually pulled back to the slow speed line. Does everyone see that? Then down here, you had retracements back to the fast speed line again. All right. So then over here, see pullbacks to the fast originally, then the next one pull back to the slow. Okay, then over here, this one pulled back to the fast for a continued down again, more back to the fast. Then the last one here was to the slow and actually went slightly beyond the slow before it went ahead and moved back. So typically what we're looking for stops on these, in my opinion, this is my opinion only, you can adjust this how you see fit, is typically 5 to 8 ticks back behind the slow speed line. Okay, 5 to 8 ticks. Because again, gang, if the expectation is, if this is going to work, it should go ahead and hit those speed lines and start to go ahead and push down again. Does that make sense? Yes, Ronnie, yes. Hey, by the way, Casey, I was hoping to catch up with you. Got your message, but it was super late last night. So you're in Georgia, aren't you, Casey? If I recall correctly, it was like East Coast. Yeah, so it's like, ooh, that's going to be kind of late. So hopefully we'll catch up here going into tomorrow, or later tonight if it's not too late for you. So no, but hey, Casey, that's you know what? When we catch up, I'll give that to you. So I'll give the information there. All right, so let's go ahead and take a look here on the Dow futures. All right, same thing, same concept, looking for a pullback to the speed lines. Okay, you can either take it a little bit earlier at the fast or wait till it pulls back to the slow. Again, if you wait till it pulls back to the slow, the benefit is you shouldn't have to wait too long to either have it reverse right back into your direction, or if you're going to have a stop out, it's going to be a much tighter stop out. Okay, so again, some of the elements, and I'm not throwing in anything about my momentum and trigger indicators and anything that stuff. We're just keeping it real simple here. Looking at a 20-period exponential moving average and looking for pullbacks to the speed lines. Okay, again, the you'll see with the Dow here, this is a great example because the fast speed line here was at 12,340. The slow speed line was 12,360. Does everybody see on this 15-minute chart? There was a 20-tick gap between the, so about $100 gap between the fast speed line and the slow speed line. Does everybody understand that? So that's why I said in a situation like this, it would make more sense with a $100 gap to wait till it gets back to the slow speed line. Does that make sense to everybody? Real important small lot trading technique, and of course I'm just hitting these. I'm just grazing this at the tip of the iceberg here. There's, we literally can and will talk for days on this as we go into this. But the right here then, so what we see is we got a 20-tick gap between the fast and the slow speed line. You go down here, now this is what you're waiting for. So instead of going in and taking it at the fast speed line because of that $100 gap, now I'm going to wait for it to pull back to the slow speed line. Can everybody see that? If you look at that real close, you can see it pulled back to the slow speed line, and then as soon as it hit the slow speed line, it came charging right back down. So it dropped there from the 12,330 area down there to the 12,250 area, so about 80 ticks over the course of the next 45 minutes right after hitting that speed line. Okay? So so here you saved yourself a lot of heat. Instead of going ahead and entering here, even though this would have worked, it would have worked by getting in here, you saved yourself a lot of heat in case it rode back up here. That's one of those keys for the small lot trader. All right, and so the whole point of what we're trying to accomplish here, the whole thing that what we're trying to do is start to develop a series of tools and trading techniques that we can go ahead and have that help us get into a trend, get us into a trend early, but keeps a lot of the heat off of us, and keep for tighter risk-reward ratios, right? Because every tick counts as a small lot trader. Yes, now if you're a small lot trader, going ahead and having your order out there in proximity of the speed lines, you can have a limit order sitting out there waiting to go ahead and hit you. There's nothing wrong with that at all. If you're a large lot trader using these techniques, like when I'm doing my large lot trades, if I'm going and putting an order out there for 10 or 20 lots on gold or crude oil near these levels, I'm going to have a real hard time getting filled. Okay, if I'm doing a 1 lot, 2 lot, even on gold and crude oil, I'm usually going to be fortunate enough to get a fill. Okay, if it's going to pull back to those areas. So if you're a small lot trader using these small lot techniques, it's going to be a little bit easier to be a little bit more nimble. Does that make sense? But a larger order on a less liquid market is going to go ahead and be, an issue. Okay, so what I just want to do, we're going to turn it over to John here in a moment, but I want you to see this whole concept that what we're looking for, we're identifying the trend. We're looking for, if we're looking for a long, we want the fast speed line above the slow speed line and above the 20-period exponential moving average. We want that exponential moving average trending. Okay, and then we're looking for a pullback to either that fast speed line or the slow speed line, and then we're looking for a resumption up. Does everybody understand the concept there? Does that make sense? It's very straightforward. This is a technique that I'll spend a great deal of time with you guys at an upcoming event because as you can see, I have many different types of speedline continuation trades. If you take a look right back over here, I've got numerous types of different ones geared towards the small lot trader versus the large lot trader. Small lot trading involves very specific strategies, okay? Steve, we're really not going to need to go ahead and do that for today since that's a custom indicator of mine. I'm trying to keep this very relevant to everybody here as small lot traders. If you want to go ahead and learn more about that, you can either contact me or come to the upcoming class. But the what we're trying to focus on here for people is the one thing I'll tell you. For some reason, a lot of people think, oh, is that the squeeze? No, it's not the squeeze, that's for sure. Basically, the squeeze is developed from John Bollinger's work, which is great work. John Bollinger had the Keltner channels and the Bollinger bands. Great stuff. And so the squeeze is a graphical representation of that. The triggers here don't go ahead and involve either Bollinger bands or Keltner channels. It's completely different math. So as far as the time frame for the types of trades, yeah, as far as the time frames, it does matter, because whatever time frame you take the trade on, you kind of want to follow it through on that time frame. So if you take the trade on the 15-minute chart, your stop out is based on that the speed line on the 15-minute chart. If you take the trade on the hourly chart, your stop out is based on the hourly chart. So whichever one you're entering in on is where the stop out for a loss is going to go ahead and be factored into. Okay, you're not going to take the trade on a 2-minute chart for a retracement, which you see here, and a pull down, and then all of a sudden manage the trade off of the hourly chart. You won't do that as a small lot trader. Okay. So I'll definitely take more questions on this, but John has got a lot of great stuff I want him to show as well, because small lot trading, this is really important. We've got a whole great class that we've put together for you on just this topic. So now just imagine what you've learned in 30 minutes here and multiply that exponentially, because this is just the tip of the iceberg. So with that, John, I'm going to turn it over to you, because I want you to show some of the really cool stuff as it relates to today, and then we can go back and put it all together.
Very nice, Rob. Thank you very much. Did everyone who had questions, if they didn't get answered from some of what Rob's material was, I know we'll have a little bit of time because we want to make sure that everyone has that understanding. Just a quick question, not question, but apparently, first off, before we get started, can everybody hear me all right? Does this sound good? Awesome. All right. All right, so let me switch recordings here and make sure everyone can see. Everybody should see the screen. See it. Okay, that's a good thing, right, Rob?
That's a great thing. You're looking good. And there's a lot of people sent a lot of nice comments here after we did the first part of this, John. I just want to thank everybody for that. That's great. But John's got some great stuff to share too, and this is just the start.
All right. So first off, with the way Rob and I have been doing things together, we have many different techniques, but at the end of the day, I think it's really helped a lot of investors, and especially many of you who are have seen my work before, either from TradeStation or different books, or perhaps you guys are using Thinkorswim and use the PPS momentum indicator on Thinkorswim. With that, I also had a few proprietary patterns that I've created and let loose on the world, and many of those we've taught around the country and been doing it presentations and seminars, because as a trader, just like for someone who's just beginning, for someone that does not have immense capital yet as a trader, we need to look for the most high probability. High probability, I guess when you sum it all up, means the safest trade out there, one that's going to give me the least risk for the most reward in a short period of time. Would that be a good definition of high probability for everybody, if we're on standing ground there? So, with a lot of what Rob showed about was in trending market conditions, and a lot of times we come into the markets and it's not really all that trending. Like, for example, today when we first got into the markets, today was just the most horrendous, boring, choppy morning session that we've seen, the typical summertime doldrums. However, by the end of the day, man, things really changed, and changed in a big way. So first off, let me do say this. Rob was complaining about the music or sounds in the background, and I was very quiet, and I didn't say anything, and I didn't want to interrupt him, but that was me. And those are actually trade alerts, and I'm having a hard time disengaging those for right now, because the presentation I want to talk about has to deal with how do we look for certain patterns, how do we trade those patterns, and I want to teach you that right now. And one of the patterns that I teach in my mentoring classes, and I don't know if we've got anyone that's ever attended one of my mentoring one-on-one classes, but we've definitely taken it to a degree where we show people this at private seminars. We teach this to our Trading Trigger University trading students, and I'm going to share with you an entry technique. Now, I know there's probably a few of you out there that are part of our newsletter advisory service, and you've seen us come out with some amazing calls this year. And you've seen a lot of times where even we put out trade recommendations days, weeks ahead of time with specific price levels, and the market will come back to us because we're using a snapback approach, and the market comes back to us, and we miss the entry by, in a lot of cases, a penny, 5 cents, 3 cents on a lot of stock trades. So it does happen to the best of us. But again, as an advisory service and someone that's not hands-on right there every second of the day, it's tough to get that exact penny. But for you folks, for you individual traders, the techniques that I'm going to share with you today, the techniques and the order entry method that I'm going to share with you is something that we have taught, and I don't think you've ever seen me teach this publicly ever before. I want to make sure that everyone's probably sure of that. What we have done at private seminars is teach people bearish market conditions. So I'm not going to teach bullish market conditions, because if you've been listening to me, if you have heard me doing our regular Monday planning and scanning, anything about me, you know I've been extremely cautious on the market for a lot of good reasons, and I think today just the market showed its hand. And so how do we go forward? In fact, Rob and I were out in California with TradeStation, what was that, 3 weeks ago, Rob?
Yeah, it's right about there, about 3 weeks ago.
Okay. Jay Smith says his screen is black. Is it supposed to be? So I'm not sure if the screen popped up.
Jay may just have to log out and log back in. John, you're looking good here. Everybody else
Okay.
can see it, and you look great.
All right, great. Well, one of the patterns we talked about was the low close doji. Is everyone familiar with the low close doji pattern at all? Cool. Did you trade the low close doji pattern today? Joel Mascot, absolutely. Rob Smith. Joel says yes. Rob, no. Wayne, no. George Valley, no. How did you miss that? We even tweeted that. In fact, here's something I want to share with you on Twitter. FYI, 60-minute low close doji pattern in the ES, and I probably should have put more exclamation points, and that went out at 12:15 today, by the way. August 26, 2013. Just thought I'd share that with you. So this is something we are looking. Yeah, I know you're still learning, George, but it's pretty cool, and we're going to share it with you from top to bottom, and more importantly, share wonderful news on how a small lot trader can actually trade it. Now, Rob showed very instrumental techniques on getting into a trade, and I'm going to show very instrumental techniques on a specific pattern. If we're bearish, obviously we look for a lower high, we look for lower lows, we look for closes less than an open, we look for closes lower than past closes, and most importantly, we look for closes lower than prior lows. Now that's a very important concept. Close below a prior low. Market closed below a prior low. So with that said, let's focus in on the low close doji. Now it seems a little complex, but it's not, because we got a couple numbers on the screen. And these numbers, meaning there's 3 here and there's 4 there, and you know, sometimes that might confuse people. And I just want to make sure that everyone doesn't get confused, because here are the rules. After a market has a long uptrend and in a bullish trend, you see a doji pattern. And for those that don't know what a doji is, real simply, the market, there is no real body. There's no definable difference in value between where the market closed in that current bar to where it opened. Notice that the low of the doji is right above this dashed line. 2 bars later, so the next bar, then this bar, the market 2 bars later closes below the low of the doji. Everyone can follow that. Well, my rules is you want to look to get short on the close within 3 bars of the doji. In other words, the doji, the next bar is 1, the next bar is 2 in this example. If it happened in the 3rd bar, then it's still a valid signal. If it happened the 4th, the 5th, the 6th bar later, negate it. It doesn't really work as effective. So within 3 bars after the doji, if the market closes below the low of the doji, then you have an entry to get short. You get short on the close or the next session open. Now that's very important, because most people would say, but man, from where the market closed to where my stop has to be might be too much risk, especially for a small lot, a smaller sized account trader. So what do we do about it? We're going to show you that in a minute. Now, where does your stop go? Typically above the high of the doji or above the highest high of the last 4 bars. In my work, typically the doji is the high or the preceding bar is the high. So it's within 4 bars of a major reversal. Does everyone follow this? That wasn't that complicated, right? Please show today's doji. Scott Lynch. Scott, you got it. Just for Scott. Rob, make note of this. Scott Lynch, he's asking for today's trade. We're going to show you today's trade. Not only will I show you today's trade, I'll show you today's trade in several different time frames. Here's one time frame. This isn't even the time frame. Well, this is a 60-minute right here. Is that the low? Is that a doji? Is that the close below the doji? Is that an uptrend? Just a cut to the chase, and there it is. So, but if you say, John, if I've got to place my stop and I'm going to get short on the close of the next session's open, and my stop has to go above the high of the highest high of the last 4 bars of the high of the doji, perhaps this area right there, that's the highest high of the last 4 bars. If that's where you're getting short, you're risking 4 points. This is an hourly chart. How do we get into the trade with a little less risk? How do small lot investors take that trade? That's what we're here to show you. By the way, here's another one right here, but none of us would probably trade that because it happened at 2 in the morning. All right? So there is today's trade. By the way, here's the Dow. By the way, here's the NASDAQ. This is pretty wild, because on the NASDAQ, and even a definitive pattern, you may have found the high of the whole day on the NASDAQ was a doji, and the actual pattern really was what sparked the whole move today, was the NASDAQ. So we're gonna get into this. It's such a powerful trade. It's such a high probability trade. It comes with a defined risk factor. I don't understand why people can't comprehend this. And when I say that, I don't mean to be mean, but when we were out in California, do you know we actually had people say, yeah, I didn't understand what he was saying. He had something like 4 bars later and 3 bars later, and I didn't understand it. And to me, it's very simple. If after a long uptrend the market forms a doji, the last thing I want to see is the doji. I want to see the continuation of bullish strength. What is bullish strength? Bullish strength means the market, this big tall green candle, that's bullish strength. It closed above its open. It closed above past or prior highs, right? You see that? The market continued to make bullish momentum. It continued to make bullish momentum, and all of a sudden you get a doji. And what is the first thing that we see? I want you to follow with me in this trend. So this market makes a high, and it has a bullish breakout. Every single corresponding candle never closes below a prior low. Do you see that? All the way up, except for right there. That's the first time the market made a lower closing low. So when I went over here and I said, when the market, bearish market conditions is when we make a close lower than a prior low. That's very important because now we have a real shift in value of the market. We have a market that's breaking down below prior support. What is prior support? A prior low. Isn't a prior low in an uptrend you see higher highs and higher lows? So if you break the low, it's one thing to break it, but if you close below a low, that's pretty important. So my research, when I did the and published and produced and put this low close and high close doji study out over a decade ago, you know, it was really an amazing pattern that was high probability, B, it was very frequent in nature, C, it was generally extremely reliable. So here's the deal. We also, just like Rob, if you've looked at, and as you see a lot of my charts, and I'll show you with my TradeStation platform or my Thinkorswim platform or Genesis platform, which I just had up, as you can tell, we have these little dots, and those are the momentum indicators. They're buy and sell signals. A blue dot gives you a buy signal to the upside. A fuchsia pink dot gives you a sell signal to the downside. But that momentum indicator comes after typically a shift in a change in value. And if you can identify that low close doji, I think you're off to the races in getting an enormous head start in trade setups. So with that said, I want to really kind of harp on this and then also talk about how we could use moving average settings to aid you. And that's why we have them on Thinkorswim and the PPS indicator. That's why we've created these, because they do all the moving average is a moving trend line is really what it is, okay? It's an average of prices. We could go into a moving average course and teach you to take moving averages of what I use, a pivot point. You could use a moving average of the range, the high-low close. You could use, or the high and low. You could use a moving average of highs, lows. Most people use a moving average parameter setting on just the close. So if you're using technical analysis to help you to determine market direction, okay, the first thing all market technical indicators are based on are what? Price. So with that said, it's very important to watch price, and that price pattern that I just shared with you with the low close doji is very instrumental. So when we see a setup, and that's the setup, the doji, the trigger is when the market closes below the doji. When we see that, if the risk is too great, because now what is the risk? If you get a low close doji, what is the risk? Let's see if everyone was paying attention. What is the risk when you see the low close doji trigger? Ah, man's perfect. The high of the doji, or the highest high of the last 4 bars. You guys are right on top of it. See, it wasn't complicated. I knew you. I have faith in you. So that's right, the highest high of the last 4 bars or the high of the doji. Perfect. Okay, so now if the market closes at, let's say, 63 and the highest high is 67, I know I have what? From 63 to 67 is a 4-point risk. Bingo. I know what my risk is. Too much for me. Cut your lot size. I can't cut my lot size. I'm only in one trade. Ah, okay. Here's what we can do for you. You're going to enter, if you're only trading one position, or if you're trading at least 2 positions, the second bullet point, number 2, is for you. Enter half your position at the market and then place a limit order between the close of the bar and the distance of 75% back to the last known value of a moving average. Now, that's a very powerful combination sentence of being able, and I think that is one of the key things. So I want to say, first off, for Kristen and Mans and Alois Santa, hello, how are you? Jonathan, Christos, John, Phil, look at everyone. George Volley got it. Jeff Miller, Jose, Steve, Vasilis. Oh my gosh. Vasilis, how are you? I haven't seen you in so long. It's great to have you here. Ed Wall, John Durham, Rob Schmidt, for sure. Nora Post, look at all these. Everyone got this right. Excellent. Okay. So how do we get it right if we have a low close doji, all right, and the market snaps back up, and the market, you miss the trade, and you go, wow, this is a little too much risk for me, okay? A little too much risk may get people a little on edge. So what we like to do is use what I call the snapback approach. What is the snapback? So let me ask you this question. If this is on this current bar right here, even though it was a low close doji, and you missed the trade, but the market has a snapback. Do you see where the moving averages are? Do you see where the market closed? Instead of saying, well, gee, sometimes the market will snap back to near moving average values, well, typically what happens is, since the keyword is moving, moving averages move after the fact. So you want to use between 50 to 75% from the value of where the current close is to the last known value of the moving average, and then look for the market to snap back, as we call it, or regress to the means to allow you to come back and get filled in the market. So instead of chasing the market, adding to the risk, you reduce your risk and reduce your size, reducing your exposure to the market. With that, you should be able, if you can just maintain.
Hey there, John.
Yep.
John, I'm not sure if anybody else is hearing it, but I'm hearing a great deal of music come through right now.
I have no music. What kind of music? Is it the Rolling Stones?
Is anybody else hearing that by chance?
Is it the Grateful Dead?
Wow. Okay. All right. Well, no worries about it. We'll go ahead and, okay. Excellent. Looks like that's fine. Good. Sorry, John, to interrupt there. There was music that was coming through over here, but I just want to make sure it wasn't on your end. So more of your trade alerts going off. So it's all you, buddy.
It's not trade alerts. It's not music. Maybe you had too much fun this weekend?
It was
Guy Lowry's telling me I have good taste in music. I just mentioned all the old stuff, the Stones, the Dead. Anyway, sorry about that, guys. So what I'm trying to share with you is a specific order technique. It's not that hard to figure out. Look at the gap between where the close is and the moving average, and if you can look for the market, just being a market maker, you can look for the market to snap back. So here's a good graphical depiction of the market. Okay, so with that said, let's take this a step further. All right. Now, oops, we didn't want to do that. With that said, if the market forms, does everyone agree we have a low close doji with this little orange triangle? Okay? So look where the moving averages are. If the market's closed here and the moving average is way up there, instead of chasing the market and selling it immediately as a small lot trader, the discipline is to place a limit offer at the market, not all the way back to the moving averages, but 75% of that value, between 50 to 75%, and then you'll allow the market to come back up to you to get filled. Does that make sense? So you have a change in momentum of the market. It's going up, all of a sudden it stalls. You get a low close doji. Now you got an area saying, hey, I should get short this market. But if maybe taking a 3.5 to 4 point trade of risk is too much for you, then reduce that down and look for the market to snap back and let the market come back to you, trade through you in order to do you, is what we say. The market has to trade through your offer in order to get filled. So therefore, you're allowing the market to come into you. So here's a low close doji, and this is the S&Ps. All right. Now, if you take a look at the screen, it may, from this particular vantage point, notice that the market has this big little rally up here. We also have a shooting star, but then we have the low close doji, and you say, gee, from where my stop has to go, from where that product has just closed, wouldn't it behoove me to maybe take a little bit of a snapback and to see how the market responds? Another technique is, as the market has typically the market moves down, as you get that loss in momentum, remember, higher in a bullish uptrend, you have higher highs. In a bearish downtrend, you have lower highs. So imagine that you should probably start to establish a range, and the market will expand back. But that's the problem. A lot of people think it's going to expand all the way back. If the market's truly bearish, it shouldn't get above the highs of these dojis if the market is truly going to reverse. But you can use that information to your advantage by placing an offer on a snapback to allow yourself to reduce your risk. Now, today in the euro currency, this was the most pathetic trade, but a situation at the time. But as it was pathetic because in over 2 hours, the market didn't even move about 12 ticks. That's pretty pathetic. But, I mean, we deal with what we have when we have it. But even in the trading room, we said, hey, here's a low close doji, and you know, the market just wasn't going anywhere. It was actually trapped between a 15-minute low close doji and an hourly buy signal. So, but notice the relationship here. We get that low close doji. Look what the market does. It allows, and that's what I wanted to share with you, more times than not, the market will come back near the moving average. So if you're, instead of going and selling all the way down and taking a little bit of heat on the trade, since this is a high frequency trade, you're going to be able to see other trade setups. You just have to know what to look for. Now, combine the fact that you get a PPS sell signal on top of it, it just adds to the bearishness of the pattern. But at least you can get some type of a trade setup out of the deal and look for the market to snap back to you. Now, we talked about this in the trading room, and part of the reason that I'm extremely cautious on the market is one of the things that we did today in our planning and scanning group is we asked how many people look at monthly charts. And I know this is small lot traders, but if you look at the higher degree time frame, you might get a better case of what side of the market to be on, or more importantly, whether or not you should be trusting what signals you should be trusting. If we start to look at a more bearish time frame, like on the monthly, a higher degree time frame, and it's starting to look bearish, I start to raise concerns, and then when I start to see short-term sell signals, I kind of pay attention to them, especially as I get into like looking for hourly setups and 15-minute setups. This is a stock called Target. Now, this is current as of about, I don't know, 2 hours ago. And I just wanted to share with everybody that Target and Walmart and a lot of these retailer stores have been under pressure. But the high that we've seen all month, not only did we form a shooting star back here in June, but we get this low close doji. But look what the market does. It snaps back into the moving average. So that even if you're a short-term trader and you're looking for an option trade, when you get a higher degree time frame, like a weekly, on an individual stock, option traders can take advantage of this and be able to understand that, gee, if this is a weekly setup, I should see immediate results. Now, this is, you know, just one more example of why we look for the low close doji and high close doji when we scan for trading opportunities. But I also wanted to share with you of how often they form. Now, this is the mini crude oil. And I think it's for small lot traders, there's certain markets that might scare people. And the big crude oil, when it has an average true range between $1.20 to $1.30 or so, I can tell you this, that's pretty scary when you're making an every 5-minute bar almost, you know, you get almost a 60-cent or 50-cent move. That's $500 on a big contract. But the little contract is not that bad for small lot traders, especially when the patterns form, and especially the low close doji. So if you think about it, even though you get a low close doji formation, you still get a snapback into the market. So if you can just be the key is A, look for the snapback, or then start looking for other entries. And Rob just shared with you some of his more advanced entry technique. So what we need is we need key reversals. We need a reliable reversal pattern, and then how do we execute them? So if we have limited funds, if you have limited risk capital, and you want to go with high probability trades, just knowing what to look for, but more importantly, how do you trade it? How do you get into the trade? Now, how do you trade this pattern? Here's the low close doji. How do we get into this? Do we go at a market order? Do you look for 75% of the snapback? Or maybe do you go with a stop in under 1662? What do you guys think? First off, is this a low close doji? Casey says yes. Then Van Kanesh says no. Van Kanesh, absolutely. We've got Dale and Alois and John and Vasilis, Peter, Eugenio, Ed, Barton, Jeff, Steve, Ron Brown, Ross Armour, I think no. Larry Rob Rollison, I got to put my reading glasses, says, I think no for Ross. Well, I got news for you. It is. Did the market close below the low of the doji? Did the market close below the low of the doji? Okay. Was this an uptrend? Yes. Very good. So if this is the close and it's below the doji, it happened the very next bar. That's one bar. So it's within the 3-bar rule. Okay? It's within the 3-bar rule. Very important. Perfect. So the high is up here. Your stop would have to go above the high of the doji or the highest high of the last 4 bars. Isn't that within, this is the current bar 1, 2, 3 bars. So there's your stop above this high. Agreed? Forget the EMA. Doesn't matter. Remember, the low close doji supersedes. It's like a royal flush. It's the royal flush. Remember, moving averages, the higher the time frame, the moving average, the less sensitive it is to price changes. You could have a 2-period or a 3-period moving average, and it's still not going to cross over until later. Remember that. Now, so that's why we look for, at the very first portion of my presentation, I said the integral parts of what creates indicators is based on price. If the market starts to close below, look at the uptrend, green candles. Look at where the market's closed, closer to their highs, above prior closes. It closed above prior highs. All of a sudden, you got a red candle here. It closed closer to the low. The next candle made a consecutive lower high and lower low. The third candle makes a close below a low, but it's not any low. It's the doji low. That's what you guys have to learn. Now, I have a key potential reversal to the downside. I don't know if the market's going to just come back to 1658, which is the pivot point. I don't know if the market's going to go to 0. But I do know that I have a reversal of a bearish momentum. And here's the key. Now it's a matter of how do I get into the damn thing? Do I sell it right here at 63.5? Or do I look for maybe a snapback? And, you know, for this kind of a situation, it's not a huge risk. So perhaps I would just say, hey, let me see if I can get an uptick to, like, say, if the moving average up here is 64.25, what do you think? From 63.5, 64? Is that being a little, it's being a little greedy, but would you agree with 64 as an entry to have an offer up there resting? $64. So my stop's got to be 68. I'm risking 4 points on an hourly chart. Now, JW asked if I use any volume rules at entry location. Obviously, you could probably see, and I'm have at the very bottom something we taught at our prior sessions Rob and I have done. This is the on-balance volume indicator. As you can see, the trend of the market as price is going down, what's the trend of the volume? It's going down. So this is actually an exciting setup because we had a huge surge in volume to the upside, and they're taking it all back again. So the moral of the story is this market has lost bullish momentum. I now have a defined risk pattern. I could reduce my risk, and so the key is, how do you trade this market? A market order to get in, a snapback, or do you place a stop underneath that low and let the market take you in as if it continues to the downside? That's the key. So for a small lot trader, you can do a combination all of the above. So actually, the market snapback would have filled you at your 64. So for those guys and girls who said, yeah, 64, we could go with 64 as an entry, perfect, okay? Perfect. Actually, from 64 to the one tick above the high was $187 risk. Can everyone risk $187 on a single one lot? Obviously, if you're risking 187, your minimum objective is 187. So Larry Rollison, 187 for you, and I wanted to say the guy who's trading the one lot, I want him to say, yeah, I can handle $187 risk. Now, Mark says it's a decent risk. Wayne's has got a decent risk. I mean, it is a decent risk. Now, obviously, I cut this short because we know that the market fell a little bit further, and this is today's 60-minute chart on the low close doji, which we had not only hopefully everyone now knows how to utilize and work with this, but even if you get, and here's something that we teach for, and we don't teach often I've never taught it in the general public. I teach it at seminars, but I use the two-tier approach. And actually, Rob talks about trading championships, and I actually used this technique when I was at a CME trading championship, but they didn't call them championships in those days. It was kind of like a trade-off, literally. It was me and another very famous speaker, and I was looking for a snapback, and what I did was this exact strategy. I looked for a snapback, I placed my offer at my 75% rule, and I place a stop underneath the low. So that way, if the market comes back up and doesn't trade through me and do me, it at least takes me into the market on the way down. So the stop-in method below where the market makes that swing low, because if we do get a snapback up and you don't get filled, let's say I was working 64 halves and the market hits quarter, doesn't trade half, trades quarter, 15 minutes go by, I still don't get filled, I can get stopped into the market below that swing low and let the momentum of the market take me in. So I have a very powerful way of getting into the trade, and as I get into the market, if it takes out that low, my stop initially goes above the high of the current bar, which, as you can see, is about a 4-point risk either way you look at it. Okay? So, Rob, I'm sure you have, as far as looking at the market, and this is a very powerful technique, we got as traders to look for, and this took all day to form. So number one, discipline and patience, those are the two main characteristics that we need to acquire as traders. And you can't be down on yourself, and you got to say, listen, the trade will come, and you have to wait for it. When the trade comes, what we don't want to see happen, especially to new traders, is to wait patiently for the right trade. You place an order, and you don't get filled, and you miss the whole thing. Folks, that will ruin you emotionally. It's frustrating, and I think that and I know the entry techniques that I use, I know the entry techniques Rob used can help you to get into the trade with confidence. If you have your risk down, and it's not a blind shot, well, I'll put a stop 10 points above. That's ridiculous. I think if the market has a true reversal in the momentum of the market, then you should see immediate results, number one. And number two, if the market is truly bearish, shouldn't we see consecutive series of lower highs and lower lows? So if that's the case, when I say place your stop above the high of the doji, you never said permanently. I never used that word, permanently. Initially, place your stop above the high. We get to manage the trade and we get to trail our stop. Now, for one-lot traders, we need to have profit objectives, and we definitely, especially for one-lot traders, you have to kind of look at areas of profit targets. So even if you're only looking at maybe 58, 56 handle, like take out the initial low of the day, those are good targets to have. No, 9 times out of 10, the markets will kind of just stall, or you'll run out of daylight savings time and you can't stick with the day trade. So with that said, I just wanted everyone to take a visualization, write this down. There's 3 different entry techniques, or you can stagger it, that if you look for a snapback in the market and you don't get filled and it starts to move down, stop yourself into the trade at the appropriate spot. And I know Rob can expand on that a little bit. And so, Rob, your method that you talked about today is we start to develop a trend in the market, and this obviously starts a trend in the market. There's other methodologies that we can use.